Hi everyone, welcome to my YouTube channel Learn Commerce with Namita. I am Namita Mane. In today's video, let us discuss about Banking Regulation Act 1949, the important provision under Banking Regulation Act 1949. This is my third video on this topic. In my last two videos, I have explained definition of banking under section 5B subsection B, business of banking company, prohibited business, capital requirement, management under section 10, section 10A and section 10B. Section 18 and section 24 deals with the maintenance of liquid assets which the banking companies are required to maintain. Section 24 defines the licensing of banks. If any new bank wants to commence the business in India, they are required to take the license from RBI. And if a bank wants to open a new branch in any city, or if they want to transfer the branch from one location to another, for this purpose also the banks are required to take permission from Reserve Bank of India. Section 35 deals with the inspections of bank. So in the last two videos I have covered all these points. In today's video I am going to discuss about powers of Reserve Bank of India, returns to be submitted, acquisition of business, amalgamation of banking companies, and last is section 56, that is application of the act. Application of the act means Banking Regulation Act 1949 to Cooperative Bank. So let's start. First is powers of Reserve Bank of India, section 35A and section 36. So the Banking Regulation Act has given some powers to Reserve Bank of India to control all the commercial banks in country. So RBI exercise control over all the commercial bank. All these powers or the rights has been given by Banking Regulation Act 1949 to Reserve Bank of India as per section 35A and 36. So second point is all powers has been centralized in the hands of Reserve Bank of India with a view to regulate the banking system in the national interest, means in the interest of public, and to prevent bank failure. So there are some powers which are there in the act and which is given to Reserve Bank of India to regulate the whole banking system in country in the interest of public and to prevent the bank failures. These are some powers of Reserve Bank of India. So the first power is, there are more powers. I have selected few powers. So the first is power to issue license for new banks and grant permission for new branches. If any new bank wants to commence the business or if they want to start the banking business in India, so they are required to take a license from Reserve Bank of India and they can commence the business. And if any bank wants to start a new branch, or if they want to transfer their branch location from one place to another, so they are required to take permission from RBI. Next is power of inspections of banks. All the commercial banks or every banking company, RBI can inspect the books of accounts of all these banks. Then power to issue direction. Reserve Bank of India has right to issue direction to all the commercial banks. Next is power to give advice to central government. So Reserve Bank of India is having right to give advice to central government in terms of financial transaction, if in terms of growth of economy. Then power to appoint liquidator. If any bank is having amalgamation or it is winding up, so in that case RBI can appoint or it can act as a liquidator to that particular bank. So these are few powers of Reserve Bank of India under section 35A and section 36. Next is returns to be submitted according to the section 23 subsection 3, section 26, section 27 and section 31. So all the banking companies are required to submit the following returns to RBI in the prescribed form, and the manner as at the close of business on the last Friday of every month. So all the banking companies, like whether it is a private bank or commercial bank, cooperative banks, they are required to submit the returns. They are required to submit some documents in a prescribed form on every last Friday of every month to Reserve Bank of India. So the returns are, first is return of liquid assets and liabilities. Returns of liquid assets and liabilities. Every banking company under section 23 subsection 3 is required to furnish to Reserve Bank of India a monthly return showing particulars of its assets and time demand liabilities in India. Okay, so every banking company under section 23 subsection 3 is required to submit a monthly return showing a particulars of its assets, how much the bank is having assets, and the demand and the time demand liabilities to Reserve Bank of India. And this report or this return is to be submitted on last Friday of every month. Next is returns of unclaimed deposits. Okay, so next point is return of unclaimed deposits. So according to section 26, every banking company is under obligation. Means it is the responsibility of every banking company to send a statement showing the unclaimed deposits. The deposits may contain all accounts. Means these deposits may contain all accounts in India which are not been operated since 10 years. Okay, so all the banking companies or every banking company has the responsibility to show the statement showing the unclaimed deposits. Now there are many types of deposits which bank accepts, like demand deposits, recurring deposits, fixed deposits, and if these deposits are not claimed by any customer, so the banks are required to show the statement to Reserve Bank of India that these deposits are not been claimed or not been operated from 10 years. So these documents or these returns the banks has to submit to RBI under section 26. Next is monthly returns. Section 27 requires, as per section 27, every banking company requires to submit RBI a monthly return showing its assets and liabilities in India on the last Friday of every month. Okay, so every banking company are required to show the statement of its assets and liabilities monthly to Reserve Bank of India on last Friday of every month. And if on the last Friday of every month is a public holiday, then they are required, the working should be of the preceding working day. Okay, so they should submit the statement the preceding working day. Next is returns of annual account. Now as per section 31 of the Act, every banking company shall prepare the final accounts. Okay, final account means profit and loss account, balance sheet, and they are required to send it to Reserve Bank of India with the auditor's report, and along with the if they are sending to the Reserve Bank of India, and they are required to publish it to the public also. Okay, so as per section 31, all the banking companies, they are required to prepare profit and loss account, balance sheet in a prescribed format under the under schedules. Then, and they are after it is prepared along with the auditor's report, they are required to send it to RBI, and after RBI they are required to publish in their annual reports to the public. Next is acquisition of business. Section 36 AE to section 36 AJ. Okay, so section 36 AE to section 36 AJ provides for the acquisition of banking company by central government on the recommendation of RBI. Now, what is this acquisition? Okay, acquisition is when one bank purchase most or all of the another bank shares to gain the control of that bank. Okay, now in short, acquisition means taking over of the another bank, the small bank, into a big bank. Okay, so when the acquisition can take place, now there are two conditions. If banking companies, okay, if it fails to comply, okay, when banking companies fails to comply with the directions given to it under section 21 or section 35A. If any banking company, if it fails to comply in the directions which is given to them under section 21 and section 35, so in that case the central government or RBI can acquire that or they can take over that bank under their control. Next is when banking business is carried on to detriment the interest of depositors. Detriment the interest of depositor means if the banking company is carrying their business to harm the interest of depositors, means if they are carrying the business to do the fraud with the depositors, in that case the central bank has power, okay, to acquire or to undertake that banking company. We'll move to next slide, that is amalgamation of banking. Amalgamation of banking, section 44A and section 45. So amalgamation, what does the amalgamation means? Amalgamation means when two or more companies, when two or more banks come together to form one single bank. Okay, so that is amalgamation. Now, in order to strengthen the banking structure of the country, the RBI has been encouraging amalgamation of small bank with big bank in the interest of depositor. Suppose there are two small banks, okay, suppose for example there is A bank and B bank, okay, these both banks are small, and if they come together to form one big bank, so the new bank will form AB bank. Okay, so this is the process of amalgamation, when two small companies, or if two banks come together to form one single bank or one single company, that is called amalgamation. So RBI under section 44A and section 45, according to the act, it encouraged the banks to for the amalgamation of small banks with the big bank in the interest of depositors. Next is section 56. The section 56 is the new section which is added in Banking Regulation Act 1949, and this section defines the application of act to cooperative banks. So in the year 1965, in the year 1965, Banking Regulation Act 1949 is applicable to all the cooperative banks in India. Before uh, before 1965, only commercial banks were under Banking Regulation Act 1949, but after 1965, cooperative banks were included in Banking Regulation Act 1949. Okay, so the provision regulating the cooperative banks are laid down in the part 5 under section 56. Okay, so all the sections which are applicable to the commercial banks, they are applicable to the cooperative banks also. So cooperative banks are also regulated the working of the cooperative bank is also regulated under the Banking Regulation Act 1949. Only the difference is the paid up capital which the cooperative banks has to maintain. The commercial banks are required to maintain the capital requirement of 5 lakhs rupees. If it is a foreign banks, they are required to maintain 20 lakh rupees if the foreign bank is in Mumbai and Kolkata, and 15 lakhs if the foreign bank is not situated in Mumbai and Kolkata. And the cooperative banks are required to maintain the capital requirement of not less than 1 lakh rupees. So this is the difference of the cooperative banks and commercial banks as per Banking Regulation Act 1949. The remaining sections which are applicable to cooperative banks are also applicable to the sessions which are applicable to commercial banks. Those sections are applicable to cooperative banks also as well. Okay, only the paid up capital is different from the commercial bank. Cooperative banks are required to maintain not less than 1 lakh rupees as the capital requirement, as the minimum paid up capital, but commercial banks, the Indian banks, are required to maintain 5 lakh rupees. And if it is a foreign bank situated in Mumbai and Kolkata, 20 lakh rupees. And if the foreign banks is not having the business in Mumbai and Kolkata, then the foreign banks are required to maintain 15 lakhs rupees. Okay, so these are the provisions of Banking Regulation Act. All the three session, means part 1, part 2, part 3, I have explained in proper way. Hope you have understood all the sessions. Thank you. Please subscribe my YouTube channel, like and share the video, and please do not forget to press the bell icon to get the latest notifications. Thank you.